Chapter 8, we're going to talk about inventories and how companies measure those and record those. So again, a merchandising company is going to sell inventory as their normal course of business. They could either produce it, well, I guess a merchandising company wouldn't probably not produce it, they're probably just buying it and selling it, or it could be a manufacturing company, in which case they would produce those goods and then sell them. And then our cost of goods sold is the offset to the account, the sales account, when we sell it. So we sell it at a marked up price, and then we charge off our cost of goods sold to what we either paid to buy the inventory or produce it. So again, the merchandising company, they're purchasing the goods from wholesalers, and then they're in turn selling it. So the cost of the merchandise is going to be how much they paid to get the goods, and then any other costs necessary to get them into the condition that they need to be in to sell them. Manufacturing companies are the ones who actually produce the product, and then they in turn sell it to wholesalers or retailers, and then they're going to have three components in their inventory. So they'll have raw materials, work in process, and finished goods. So they'll have a little bit more of an advanced inventory system. Okay, so then we'll go through each one of those just so you understand. So raw materials, work in process, and finished goods. So I worked at a plastic injection molding company right out of college, shortly after college, and I'll kind of give you examples. So we made the vents, the air vents that go inside of cars. So the raw materials, we had big gaylords of ground up plastic. So again, all different types of plastic, and they were just little plastic pellets. So those were raw materials. We purchased them. They're in our warehouse. We did nothing to them. Then we would take those plastic pellets and take them out to our presses, and then our presses would pour in the plastic pellets into the mold, and then it would pop out a part. So it would be the vanes or the thumb wheel or the housing. So again, think of an air vent in a car, all those different little component parts. And then those would go on to our warehouse before it reached our assembly line. Those would be considered work in process because we did something to them, we molded them, but they weren't done yet, ready to sell. Then they would go into our assembly department, and our assembly department would put them all together. So we'd put the housing down, put the vanes in it, put the little thumb wheel on so you can turn it. And then that would be a finished good, and we would sell it to our customers. So at any point in time, we have all three of those levels going on. Just depends on where you're at in the factory. So then again, looking at it from an accounting flow, when we purchase those raw materials, excuse me, they're going to come into the raw materials general ledger account. And as we, in my example, sent them out into the presses or out to the, where they're going to be worked on, we would credit raw materials and then debit work in process. Then we would have people who work on the presses themselves, or again, when they get to the assembly lines, the direct labor, those are people who are touching the product and adding value to that product. And those are going to be applied, their labor is going to get applied to that work in process. And then the manufacturing overhead is like the electric bill and the property taxes and the maintenance men and the factory supervisor. All those people are necessary to make that product, but they don't actually touch it. So the direct labor people are the people who touch it and add value. The manufacturing overhead and all the expenses that are involved in maintaining that factory are still necessary, and they get applied into that work in process. Then once that work in process is moved on, we've completely, like in my example, molded it and assembled it. Then it goes over into our finished goods warehouse, and then as the customer orders those products, we would sell them out and then charge it to cost of goods sold. So in a perpetual inventory system, which is probably most environments right now with the computer system, everything is constantly changing. So inventories coming in and going out at all different times of the day. Again, because everything has barcodes or product numbers, and it's scanned and it's constantly moving. So the nice thing about that is on any given date, we know we have an idea of what goods we have on hand, how many were sold, that type of thing. Obviously, inventory systems can be wrong. There can be mistakes, but it still gives you a good idea of what's there. So here we have this example where they have $120,000 of inventory on hand. They purchase another $600,000 during the year. They sold out $820,000, and the cost of those goods that were sold was $540,000. They keep a perpetual inventory system, and the system shows that their inventory at the end of the year is $180,000. So then the journal entry, this is when they purchase it during the year, goes into inventory, into accounts payable. Then they sell it, so they bill the customer and record the sales revenue, and then they charge cost of goods sold and take it out of inventory. Now, if we were using the periodic system, then it's not going on every minute, every day. We can't any day go out there and see. It's only at the end of the period. We take a physical inventory and we say, okay, we know what we started with, we know what we purchased, and we know what we ended with. So the difference must be cost of goods sold, or must have been sold out. So that is our formula. So we know what we started with, we know what we purchased, and then we go out and take a physical inventory, so we know what it ended with, so we subtract that out. So then again, the difference is going to be our cost of goods sold. So same scenario, and then let's look at our journal entries. So the journal entries are very similar, but now we use an account called purchases. So we put it to purchases for $600,000. Our sales entry is the exact same, accounts receivable, crediting sales revenue. Our cost of goods sold is still $540,000, but now we have to adjust our inventory. So we get rid of the $600,000 we purchased by crediting that. We get rid of our beginning inventory of the $120,000 by crediting that. And then we debit our ending inventory for the $180,000. So then when we start the new year, we'll have nothing in the purchases account, and all that'll be in our inventory is this $180,000. So here again, I feel like it shows you the same thing, but it's just showing you that formula. Our beginning inventory plus our purchases minus our ending inventory gives us our cost of goods sold. And then this is just a comparison. So again, I feel like now with everything being so computerized, probably most companies are using the perpetual method just because we're able to track much more efficiently than we used to be in the past. The periodic system is a little more old school, so it requires that physical count to really know what we have, but it is less costly. So if you're a small business and you can't afford the whole barcodes and all that stuff, the periodic inventory system still would work for you. So then we ask, what should we include in our inventory? So we are at the end of the year and we're counting. So we want to include the items that are in the possession of the company. If they're in transit, we go back to the terms of purchase though. So not all goods in transit are included, but certain ones are. If we own them, but they're on consignment, so somebody else is selling them for us, but they haven't sold yet, we need to include those. And then if we have an estimate of what the returns are, we should factor that in at the end of the year as well. So these are the ones that, again, are in transit. So in transit means we've either purchased them or sold them, and they're on their way to somebody else or they're on their way to us. So again, depends on the terms. So here, if the goods are shipped FOB shipping point, and we are the Lothridge Wholesale Beverage Company, we sold them to J Bar, and their FOB shipping point, then that means we've released all responsibility at our location. So then the buyer, the J-Bar company, is going to include they're going to include that inventory in their ending inventory. If we shipped it FOB destination, it means it's ours until it gets to the buyer's location. So if it's in transit, then Lothridge better include it in their inventory. So you can see though, again, if there's a lot of goods going back and forth, this could be a lot to figure out. So you do have to go back to those terms and understand it. So consignment, again, if the person has not sold it yet, if all it is it's at the location of a third party and they're just going to hold it until it's sold, then we as the owner of that inventory need to count it. If it was purchased, then we do not count it. So sales returns, we're gonna credit our cost of goods sold because again the merchandise comes back to us. If it's not defective, we're gonna put it back into our inventory and then give the customer credit. And then we should do that at the end of the period to estimate future returns. So maybe back, if we look at our past experience, 5% of the sales estimate to be returned. So we're going to make that estimate and adjust our books accordingly. So then when we purchase this inventory, so we're, say we're a retailer and we're buying the goods to sell, any costs that it takes us to purchase it as well as to deliver it to us, to our location and get it into the desired condition are going to be included in that purchases account. So those freight charges, any insurance charges, anything like that's going to be included in the cost of the inventory. We will reduce the cost of the inventory or the purchases by any returns that we then have, or if we take advantage of purchase discounts. And then our purchase discounts, again, we'll talk a little bit, we have to earn those to take them. So here's a little formula. Our net purchases are going to be our total purchases plus any freight cost minus any returns and discounts. So our freight in is going to be added, and it'll be included in our purchases account or our inventory account, depending on which system we're using. Costs that are not included if we pay shipping on the goods that we're selling, those would be considered some sort of an expense, but not a cost of, not necessarily a cost of goods sold, but it could be. Okay, purchase returns, again, if we purchase something and we returned it, we're going to reduce our inventory and our accounts payable because we no longer owe if we returned the product. Or again, if we paid cash for it and they gave us our cash back, we would then debit cash. In the periodic system, we would have a purchase returns account that we accumulate, and then at the end we would subtract it to get to our net purchases. Then our purchase discounts is when we take advantage of the payment terms that our vendors give us. So here's a common example. How we would read this is we save 2%. If we pay that invoice in 10 days, the net is due in 30 days. So we'll take advantage of the 2% discount if we pay it in time. So the gross method, you just record what you owe. The net method, you record it less the discount, again, assuming that you're going to take that discount. Then if you were using the gross method, you would record the discount when you actually earn it and take advantage of it. And again, you're reducing the value of the inventory. The net method, you've already taken it, so you just record the cash. Now this one, they give an example, they didn't really pay the full amount. So they left $6,000 unpaid. So in the gross method, we never took the discount in the first place, so we just pay the full $6,000 and it reduces our accounts payable. In the net method, we already recorded that discount as if we were going to take it. So now we have to debit purchase discount loss for what we did not take advantage of. Okay, then we have our different inventory methods. So we're going to talk about LIFO, FIFO, and weighted average. So then they give us what did we purchase through the year, what did we sell, and then what was the price that we paid for all of those purchases. And our goal is to try to figure out how much are we going to allocate in cost to those goods that were sold, how much are we going to allocate to the goods that are left in our ending inventory. So again, we had 11,000 available, 6,500 were sold, and 4,500 are left in our ending inventory. Okay, so here, again, this just showing you that we had the total of 71,500 to deal with. If it's specific identification, like if you're a big ticket seller, like an automobile dealer or an RV dealer, you know specifically the cost associated with those. If you're selling toilet paper, you don't have the cost associated. So then normally in those environments, we use one of these three methods. So average cost, FIFO, or LIFO. And then FIFO is basically what it says. The first goods that we had are the first ones that we sell. Last in, first out, or LIFO. The goods we just purchased are the first ones sold. So when we use the periodic method, that's the easier of the methods. The perpetual is a lot harder to do. So the periodic, we look at the whole entire period. What was our beginning inventory? What did we purchase? And then so what all did we have available? If we use our weighted average, we take our total costs associated with the inventory divided by the total units and get a cost per unit. And then we're going to allocate those out to what is in our ending inventory using that cost per unit, and then what went to our cost of goods sold, again, using that cost per unit. Now I'll let you look at the perpetual because the perpetual is a lot harder. So here it is. So you go sale by sale. So then you say, okay, if I sold on January 17th, what did I have available? I had the 4,000 units in my beginning inventory plus this purchase. So I'm going to calculate the average cost of those and then charge that off to my cost of goods sold and then leave the remainder in my inventory. And then you do that with every single sale. So again, it's a little more detailed, but so you can look that over. The periodic for the first in is the same way. We're going to look at the same information and say, okay, which ones did we sell? So we sold 6,500. So those first ones in our inventory are sold, and then the last ones remain. And so whatever costs are associated with the first and the last go, either to cost of goods sold or value the ending inventory. The perpetual system, again, with that is also a little harder because you go sale by sale. So then you come at your first sale and say, okay, I sold 2,000. Well, what inventory did I have? I just had my beginning inventory and they're valued at 550. So that's what I value my cost of goods sold and then what's in my ending inventory. Then you have a couple more purchases and then you sell some. So then you look at your sales and say, okay, well, how do I value those? I go back to my oldest inventory, and that is going to be my first amount that I take out and I charge to cost of goods sold. So in this case, that is we have 2,000 at 550. So that's all of them. Then what's left is another 500 at the 550, then the two that I just purchased. So you go sale by sale, but do that same process, first in, first out. Then last in, first out goes the opposite way. So it says my most recent ones are my first ones sold, and my older ones are still left in my inventory. So then again, you're valuing it a little bit differently. The perpetual is that same thing, but again, you go sale by sale. So my most recent ones that are in are sold, and my older ones stay in ending inventory. So that first one doesn't change because all we had is the beginning inventory. But when you look down here at the April 15th, they sold 1,500. Well, they're going to show okay, well, I'm going to value those at the $7 at the price I just bought, and then everything else is staying in my ending inventory. So then you see, though, the ultimate thing, we're still allocating out that 71,500. So all three methods are the same dollar amount. It's just, where are they? So the average cost is going to fall in between these two. FIFO will result in the lowest cost of goods sold in times of rising prices. LIFO will result in the lowest ending inventory in times of rising prices. And then the reverse would be true if prices were going down, which hasn't happened in a long time. Okay. And then you could match it by physical flow. So, like, let's say you are a grocery store. Your first in, first out is probably how your physical flow is going. You're moving those expiration dates out. You want those to sell first. If you're like a mulch place, then it might be last in, first out. You got a big pile of mulch. The stuff on the top is what's going to be sold first. But most of the time, companies will pick their method not by the flow of the goods, but by how does it impact their income taxes and their net income. Because both of them are GAAP, so it all depends on what they want to do. So if our prices are going up, LIFO gives us a higher cost of goods sold and then a lower net income that we have to pay taxes on. So that might be the way we want to go. Or maybe we want to flip it. We want to have a lower cost of goods sold and a higher net income because we're trying to get a bank loan or trying to build credit or whatever. So again, it's going to be up to the company to make that decision. And both of them are GAAP, and it just needs to be disclosed. And again, like, your taxes are not reduced permanently. It's only deferred because over time you'll end up getting rid of those differences. Now, then the IRS and the accounting laws get into these LIFO reserves because we could end up having older values that are in those LIFO inventories. So there's a methodology to bringing those up due to rising prices. So you want to kind of look over these, but we create a journal entry that compare, whoops, I guess, yeah, keep going. So the journal entry is going to charge it off to cost of goods sold and then credit our LIFO reserve. And then every year we adjust it by comparing what is our LIFO balance to our FIFO balance and making sure that we have that LIFO reserve where it needs to be. So like the difference between those two. So you can look over those journal entries, but again, it kind of shows you what we have, and then again, kind of where that LIFO ending inventory is compared to the FIFO, and then how that impacts our cost of goods sold. But then we may end up getting into where we liquidate some of those old costs being matched up against the current selling prices, in which case we would have huge profits in those LIFO liquidations. Because again, we're taking real old costs and matching them to our current sales price. Okay, then just in time is when we are managing our inventory so that we have just what we need in order to produce it and to meet the demands of our customers, and we're not carrying too much inventory on our system. How do we monitor that? Our gross profit ratio is one way we look at it because it involves our cost of goods sold. Our gross profit is our sales minus our cost of goods sold divided by our net sales. And then we also can use our inventory turnover ratio, which is our cost of goods sold divided by our average inventory, and tells us how many times we're turning over our inventory. And then here are some methods, again, because LIFO can be difficult because of those different layers. So we're going to have inventory pools where we group inventory by like what type of product it is, or we could have dollar value LIFO method. So here again, we're going to allocate those costs to a specific pool. So they give us an example, I think. Like, so say you have all different types of wood. Well, pine, oak, and maple all have different prices. So then we may put those in different pools, and then come up with an average cost for the pool. And then use that as our value of what we're adding. And then the dollar value LIFO, so it comes up with a cost index. So you take your cost in the layer year and divide it by your cost in the base year, and you'll get like a percentage that it's over. And then you're going to use that index to restate each layer. So let's see if we can get to one that shows us. So if we have the base year is the 400,000, whoops, sorry. So our inventory cost is 400,000 and our inventory year-end costs are 462,000 and we have an index of 105%. So we want to reduce that down to a $440,000 as our new layer. So the 40,000 represents the quantity, that 22,000 difference represents the increase in the cost. And then here again lists out some advantages of that, that it minimizes the dollar value LIFO, minimizes the probability of those older layers being charged up against our cost of goods sold, our sales price that is much higher. And then we're going to consider the acquisition of those new items at that dollar value of the old items.